Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. As always excited. You know that.
Yeah.
But the whole market is excited at the moment.
Are they?
Well, yeah. I mean,
All-time highs?
All-time highs, baby.
Yeah.
Bitcoin's back.
It's so easy.
No, the excitement comes from earnings season.
Yes.
It's that time of year again. Christmas might come once a year, but earnings season is four times.
Far too often.
Far too often, at least in America, where publicly listed companies reveal their results, tell us how they're going, and give us an insight into how, I guess, the broader economy is going and how things are holding up. The US Q2 reporting season is underway, so we've got some insights there. We're going to talk about them in today's episode. And then we're also going to cover the news of the day. So let's get into that.
News and markets.
Headlines we're covering today: surcharges are being wiped from card transactions. We're going to do a quick fire update on what's going on with tariffs around the world. Big tech is desperate for energy, and then closing out with a what the? Delta Airlines have a new way to get around the tariffs. But let's get stuck in straight to the top, Ren. The Reserve Bank of Australia has proposed a complete ban on card surcharges,
Yes,
car surcharges.
Yeah, so it's expected to save Australian consumers $1.2 billion a year. So that's not bad.
Not bad.
The change is slated to take effect in July 2026, and it doesn't need to be passed by Parliament. And I think this is interesting. The reason it doesn't is all that the Reserve Bank need to do is lift the ban on the payment networks from stopping retailers adding card surcharges. Right now, basically, there are rules in place that stop Visa and MasterCard saying, no, you can't add a card surcharge. So they're going to lift that rule, and then the payment networks are going to say, well, you can't add a card surcharge. We want card transactions.
Yes.
Does that make sense?
Yeah. So Visa and MasterCard will help lead it, is what you're saying.
Yeah. They'll be the ones enforcing the ban.
Yeah,
is kind of the point.
Yeah.
And the reason that the Reserve Bank used to allow retailers to add a card surcharge is because the Reserve Bank traditionally loved cash.
Yeah.
But they're getting with the times, and they're realizing that consumers don't really love cash anymore.
Yeah. Those that do card surcharges, won't they just add on 30 cents to the price of the product?
Yeah, definitely. Speaking of not loving cash, have you been following this Armaguard stuff?
No.
So Armaguard is owned by Lindsay Fox,
Yeah.
a trucking magnate billionaire.
Yeah.
But it's unprofitable.
Yeah.
In 2024, a consortium of large companies that need Armaguard services. Armaguard, for people unfamiliar, do cash collections and drop-offs at like physical retailers. So like Woolies and Coles,
yeah.
they collect a whole bunch of cash, Armaguard pick it up, and then they also drop
Not
off.
in Woolies, just pointing out, but yeah.
What do you mean?
We use Prosegur.
Oh, actually?
Yeah. Huge cash change when I was there.
Oh,
Yeah.
Woolies is still involved in this.
Oh,
so
okay.
in 2024, a consortium of large businesses, the supermarkets, the banks, Australia Post, came together and put a $25 million bailout package for Armaguard, 2024, owned by a billionaire. Let's just be clear. And then this week, another $50 billion bailout,
Wow.
$50 million bailout package.
Wow.
I just don't understand.
Where's Lindsay Fox?
Well, I also just don't understand why they don't.
Just let it go out of business.
Well, no, because they need the cash services.
Yeah.
Why doesn't Armaguard just raise its prices for these big customers?
Well, when I was at Woolies, there was a huge thing about pushing the prices down, and that's like why I think they changed, because there was a better offer at a cheaper price, and so I think they could just move.
Yeah. Anyway.
Interesting. Anyway, let's turn to tariffs. There's a lot going on, so we're just going to hit some of the big major updates quickly. So President Trump has announced his third trade deal. Surprise, surprise. We're meant to have 90 in 90 days, but we were up to number 3. This came after striking a deal with the UK and Vietnam. The president announced a deal with Indonesia that would see the tariff on Indonesian goods reduced from 32% to 19%. Interesting. In return, though, Indonesia would not tariff US exports and agreed to buy $15 billion of US energy, $4.5 billion in agricultural products, and 50 Boeing jets.
Yeah. That's tariff update 1. We're not going to dwell on these. Number 2 is that Trump proposed a 200% pharmaceutical tariff on imports into the US. He originally said it would start in 18 months. Now he has said it will start on the 1st of August, not at 200%, but there would be an initial tariff and it would work its way up to 200%. CSL is going to be the most affected of the Australian companies by this. It didn't fall too much. It fell about 1%. Yeah.
And then to close out, America's inflation rate actually for June, or the consumer price index actually rose. Prices up 2.7% in the past 12 months. This is the highest increase in 5 months. For context, in May, prices were up 2.4%. So obviously economists are pointing to companies starting to pass on the effects of tariffs through to consumers as the key reason for the uptick in inflation. So one we'll watch very closely, particularly as Trump is waving around draft letters to fire Jerome Powell.
I was about to raise that. So did you see on, what was it? It was Wednesday US time when that letter was waved around.
Yeah.
Well, apparently he waved around a letter. He later denied that there was a letter, but the market fell sharply, like 75 basis points, 0.75%. And then he was answering media questions and he said he wasn't going to fire Jerome Powell and the market went back up.
Yeah, it's unbelievable.
Yeah, very responsive market. I think Jerome Powell has the opportunity to do the funniest thing here.
What's that? Raise rates?
Raise rates.
Yeah.
I mean, inflation is ticking up. They have a 2% target. They don't have a target range. It's ticking up above the target. Trump is putting a lot of pressure on him to cut a full percentage point.
Yeah.
He's been holding recently. They're also, have you seen this stuff brewing in the background? How because Trump can't fire him except for cause.
Yeah.
And they're talking about this $2.5 billion renovation of the Fed's
spending
offices.
too much on offices. Yeah.
It would be so funny if you raised rates.
Oh, it's unbelievable. The market does not want him to be fired.
No,
though.
it
That is
wouldn't be
clear.
funny. It wouldn't be funny for investment returns.
No.
But it's Jerome's opportunity to give him the finger.
Yes. Come on, Jerome. Anyway, moving on. Big tech, Ren, are desperate for energy. We know that they have been buying up nuclear power plants and the like to try and have enough energy for their AI. But Google has agreed to a first of its kind deal to use 3,000 megawatts of hydropower to power its AI data centers.
Yeah, so this is a deal with Brookfield, the Canadian infrastructure giant, but is obviously in the US. It's a $3 billion deal. They are just desperate to get their hands on energy, and particularly emissions-free energy. The amount of money that these hyperscalers are putting into securing energy supply should be a real investment boon for the energy industry more generally. To put 3,000 megawatts in perspective, that would power roughly 4.4 million Aussie homes, or nearly every home in New South Wales and Victoria combined. To put it also in comparison to one of our big energy projects, Snowy Hydro 2.0 is going to be about a 2,000 megawatt capacity project.
These guys are just going to become energy companies.
Well, they're not owning the energy assets. You know, like earlier you said they're buying nuclear. They're just buying nuclear offtake.
Yeah.
And similarly, it's not like Google's going to own the dam.
No.
They're just offtaking the hydropower. Yeah. But it's like, this deal is for 150% of Snowy Hydro's capacity. It's
crazy.
It's amazing how much energy they're using. And hopefully what it sees is like an acceleration of clean energy rollout, battery storage, or all of that offsets the impact of Trump's big, beautiful bill and the loss of the tax credits and stuff like that. Because I'm sure a lot of people have been seeing the juxtaposition between the US energy rollout and China's energy rollout.
Yeah.
It's pretty nuts.
It's wild.
Yeah.
It's wild. A lot to comprehend, really. But we're going to close out our news with a What's the segment. This comes from our daily newsletter where we put in an article that has raised an eyebrow that is a little bit left of field compared to some of the headlines that we summarize for you. And today, Ren, it comes from a news story around Delta trying to get around the US tariffs.
Yeah, they found a novel way to get around US tariffs. This comes from Bloomberg, and I actually want to start with the end, which is a quote from Delta's CEO, Ed Bastian. He said to Bloomberg, quote, "We are not planning to pay tariffs on aircraft deliveries."
Okay.
And that makes it difficult for Delta.
Yeah.
Because there are two major aircraft suppliers in the world, Boeing, American, so they can get those tariff-free. But the other one is Airbus, based in Europe.
Yeah.
How are you going to get European plane parts or planes without paying tariffs?
Good question.
Here's how Delta are doing it. So they're buying new European Airbus jets in Europe. They're owning the asset in Europe, and then they're ripping the engines off those jets and shipping them to the US to install on their old US jets that need new engines.
It's crazy that it's cheaper to do that than pay the tariff.
I know. And because keep in mind, right now the European tariff is 10%. It's just the baseline tariff that everyone's got.
Yeah.
From the 1st of August, it's going to 30% unless they sign a deal. And for people wondering, if you buy a European asset and then you take receipt of it in America, then it's a cross-border transaction and you pay the tariff. But what Delta have figured out, if they buy it in Europe, keep it in Europe, and then they're just moving their own company's assets around, there's no cross-border transaction.
Yeah. Pretty smart.
Pretty smart.
But
you are right that the amount of cost that comes in the
transportation.
Yeah, and actually just physically
ripping it
taking
off
the engines
then.
off,
Yeah,
reinstalling it in the
wild.
US.
It's wild.
It is it's an inefficient way to run a global market, you could say.
You'd be peaking if you were Ed Bastian.
Why would you be peaking? I'd be pretty happy if I was Delta's
Just that it's
CEO.
annoying.
Oh, yeah. If Delta need a new CEO, I'd be happy to do it.
True. Q2 earnings season has kicked off in America. It's our chance to understand how some of the companies that we're invested in are going.
Earnings season, reporting season, the finance industry loves coming up with multiple names for the same thing. Is it the stock market? Is it the share market?
Is
one
it?
and the same. It's
Yeah.
actually the securities exchange, the
Yes.
S in the ASX. That's a separate conversation. But here we've got earnings season or reporting season. You'll see both terms used. More reporting season in Australia, more earnings season in the US. The long and the short of it, it means the same thing. It's when publicly listed companies reveal to their shareholders, us, how they're going.
Yep.
What their revenue is, what their profit is, what their outlook is for the future, any other opportunities or risks as they see it, how key projects are going. This is your chance to test your investment thesis. Is the reason that I invested in the company holding, or has the company done something that changes how I should think about the company? Should I be selling?
Yeah.
Or should I be buying more?
Yeah.
Or should I be doing nothing at all?
Yeah.
These are all your options.
There are your three options.
Now, it's important to stress the timing is different in different markets.
In the US, they report on a quarterly basis every 3 months. Here in Australia, though, it's every 6 months on a half-yearly basis. So the information flow somewhat feels never-ending in the States. Luckily for us here in Australia, you do get a bit of a time to breathe in between earnings reports.
The problem is that most of us now invest in more than one market. And so, for instance, in the coming months, we're going to have July Q2 reporting season in the US.
Yeah.
And then we're going to have August, which is the end of financial year reporting season in Australia. That bleeds a little bit into September. And then by October, we've got Q3 reporting season in the US once again.
Non-stop. So traditionally in the US, finance goes first. And what we mean by that is the big major US banks. So think JP Morgan Chase, Bank of America, Goldman Sachs, Citigroup, Morgan Stanley, Wells Fargo. The big hitters usually come out and set the scene.
And if we think about the scene coming into this, a lot of reasons to worry.
Yeah, a lot of reasons to worry. Tariffs,
economic
market.
uncertainty.
Yeah.
Like wars around
War
the world.
zones.
Questions around future interest rates, cuts, consumer confidence pretty low. Businesses recently were warning about empty shelves. They'd reduced their investments. They'd reduced hiring because of uncertainty around tariffs. And consumers were tightening their belts because of uncertainty around tariffs as well. A lot of reasons to think, how are the US financial institutions going to report this quarter? So how'd they go?
Well, uncertainty and volatility is a good thing for the banks by the looks of it, because despite everything you just said there, Ren, across the board, the banks have exceeded Wall Street expectations.
Wow.
Yeah. So let's start with JP Morgan Chase, who delivered a $15 billion quarterly profit. That's up 9%. That is wild. Goldman Sachs, they posted profits of $3.7 billion in the second quarter. It was a stronger than expected result, driven by their equities division or stock trading, which benefited from volatility, as we said.
So speaking of Goldman, they actually broke the Wall Street record for stock trading revenues in a single quarter. They did $4.3 billion worth of business in its trading group, which was 36% up from the same quarter last year.
Wow. And I guess just to put context to this, as markets are volatile, these big banks are pretty active. And so that's where they're making their money.
They're active, but also they're active. Their clients are active.
Yeah, that's what I mean. On behalf of their clients. Trading in and out. Morgan Stanley, another investment bank. So they posted profits of $3.5 billion. Again, strong quarter from trading. And then Blackrock, the largest asset manager, $12.5 trillion in assets under management.
Yeah, so BlackRock once again holds the crown for the largest asset manager in the world. It's BlackRock and Vanguard are sometimes jockeying for position, but BlackRock is the largest at 12.5 trillion AUM. There was one interesting note that BlackRock's stock actually fell like 6%.
Oh, wow.
Yeah, market wasn't.
We're not happy with that.
The market is a tough
Brutal.
marker. But one of the reasons it fell, there was one massive redemption. One customer, just one institutional customer, redeemed $52 billion. Imagine getting that call.
Wow. Hey, guys, I'm going to pull everything, $52 billion.
Imagine being the back office team member at BlackRock that has to nail that transfer.
Yeah.
Like, you would be checking the bank account details so many times.
That is wild.
I wonder what
$52 billion.
BlackRock's transfer limit is.
True. 40 grand.
So we're talking financials because they go first. I don't know why, but traditionally they always go first. In this coming week, we're going to really broaden it out. We're going to see some tech. We're going to see some consumer. So we'll start to get more insights from the broader mass of the American economy, and we'll start to get more insights. But I think the financials give us an insight into how like business investment and consumer spending and stuff is looking. And if we preface this with there's a lot of reasons to be worried, I think a lot of those reasons haven't really come through in these results.
Yeah, you're right, Ren. The commentary from the banks is one of sort of general optimism, particularly around consumer resilience. These banks have provisions for loan losses, so loans that people can't pay back, they have a provision for.
I mean, to put it in an Australian context, a number that people are always watching when the Australian banks report is the provisions for bad mortgages.
Yes.
Yeah, and how many Australians are in mortgage stress or the banks think that those mortgages won't get paid back.
Yeah.
Same in the US. So how did they go?
Well, they exceeded expectations. So I guess that's reflecting stronger credit environment or stronger resilience from consumers to be able to service their loans than Wall Street anticipated.
Yeah. And obviously like a couple of rate cuts in the US and in Australia would help those numbers, make it easier to service debt. Now, where we wanted to close this, Bryce, was you wanted to have a little bit of a crow. And you know what? I think credit where credit's due, you deserve this one. Because I can't remember when it was. It might have been earlier this year. You unveiled a new investment on the podcast, and I was skeptical.
No, it was very recently. It was best ETFs for FY26 on Get Started Investing.
Okay.
Is when we spoke about this.
Well, that was earlier this year, technically.
True.
Well, if you're not listening to Get Started Investing, that's a natural plug to go and listen to that. Our sister show, hosted by Bryce and I, really going back to the basics of investing. But you unveiled that of all the exciting investment options in the world, of all the new technology and amazing companies doing crazy things, you decided to put your money in a bank ETF.
I know. Wild, wasn't it? You and Simon were both giving me looks that I'd never seen before.
Yeah, I mean,
Yes.
think about what AI is doing to this world.
I know.
And you want to invest in banks.
Global banks, Ren. Global banks, not banks here in Australia. Global banks.
The best performing bank in the world is here in Australia.
Who doesn't want? No, the most expensive bank. Anyway, yes, BNKS is the ticker, and I'm glad that you're giving me this moment, Ren, because let's just put the S&P 500 and this ETF head to head. The S&P 500 since the liberation low of April is up 25%. However, it has not beaten the ETF that I spoke about, BNKS, which is up 32%.
Wow.
So the bank index outperforming the S&P 500.
So I'm going to be
and with
honest.
numbers like that, I'm not surprised.
So I'm going to be honest. I saw that you'd put in the notes this bank's ETF comment, but you'd only put the performance from Liberation Day lows. And I was a bit like, oh, here we go. Bryce selective timescale Lesky over here. So while you were talking there, I just had a look at the past 5 years for both the bank's ETF and the S&P 500.
All right.
Who do you think's come out on top?
Of course, the S&P 500.
No, you're underestimating
Really?
yourself. So the S&P 500, 94% in the past 5 years. This ASX BNKS ETF, 106% in the past 5 years.
I should have said that in the episode where I was pitching it.
You should have, because you were pitching it.
Yeah, well, there you go.
So yeah, look.
There's no Aussie banks in there. There's just the big global.
Yeah. So look, I think earnings season is going to be quite an instructive time, especially with these tariff threats coming back on from the 1st of August. We're going to get a lot of commentary from companies around how they're preparing for it and what they think the impact will be. So we'll be sharing all of that here on Equity Mates Investing Podcast. So if you're watching on YouTube or you're listening on the podcast, make sure you subscribe. We'll keep you up to date and we'll make sure you know what you need to know.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.